Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading or simply algo trading. We've seen this chart before several times. It's the current recipe I am using to go through and actively trade. It has been a very good process and one where I finally took my first loss, as we can see on the chart with the upper red marker. This process has proven very resilient, though, for a lot of market situations. In fact, I've talked about this strategy quite a bit, especially the volume portion of this strategy. But I've never gone into detail for the part that actually drives this strategy, and that is the channeled version or channels version of this. The part that actually makes the real decisions of when to buy and sell. That is what we are going to cover today, because trading in channels is perhaps one of the most popular and lucrative approaches there is. Trading in channels is one of the most common approaches there is. Whether you're doing it algorithmically or you're doing it manually, channels are an incredible resource. Channels are so popular that there are several indicators dedicated to just that philosophy. Bollinger Bands, Donchian, Keltner Channels, even ATR when applied to an upper and lower situation, or support and resistance. These indicators create a channel-based structure that help users find lower and upper ranges, or eliminate parts of the market where volatility isn't the strongest. There are a lot of reasons and resources behind why channels are so effective. I have taken, for my own trading, Bollinger's as one of my key examples. It is in fact one of my favorite indicators of all time, and one of my most profitable. But so are many others. And I wanted to really go through and see what I could accomplish if I took the concept of channels and combined all the best parts of Keltner, Donchian's, ATR, Bollinger's, all of the channeled indicators, and create a very unique indication of market outlook that would help me see even more opportunities. The Jackrabbit Channels Indicator, which is what we are looking at, is a combination of all of that information. Being able to take everything from the greatest indicators of the market, the most used indicators of the market, and combining them into one single resource of uniqueness. So let's get started into a teardown, deep dive of this very powerful indicator that you can find throughout the support server and from my Patreon. You do have to be a subscriber to get access to this wonderful tool. So let's get into the settings and actually start really taking it apart. We're going to start by turning off all of the unnecessary parts and go layer by layer into this strategy, into this indicator. So let's start with the very basic premise that all of the channel indicators have. They all start with a median. a moving average of some type that denotes the average of price itself. That is a critical core component of every channel-based indicator on the market. Being able to actually take this median and get meaningful information out of it, such as market trend, direction, all of the things necessary that help us get a good viewpoint of what price action is currently doing. And in the case of what we see on the screen, for this particular area, price action is in an upward trend, and then it hits a very sharp downtrend on the right side of the chart. That is very well demonstrated with the moving average we are looking at. So let's actually go through and see more about this particular moving average. Look at the median and what kind of information can be gleaned from just one simple piece of the puzzle. So going through the channel's settings, we can see that the median has an upper source, a lower source, and a moving average. For the median, in this case, I'm using the closing price and the opening price of every single candle as a part of creating that process. But that can be changed to use high and low as well, or the closing price only. For example, Bollinger Bands uses only the closing price to create its median. For the purposes of what I want to demonstrate here, let's exaggerate this a little bit by using the high and the low of every single candle. This will give us the median by which we trade with, or by which we create this moving average. But we may not want a moving average. We might want the median to be just raw price action. And we can see now on the chart, by setting the moving average to none, the median is now just the average of the high and the low of the candle. But we can have whatever we want in terms of what is available for choosing. For this particular demonstration, let's go with a classic technique of changing the median to a volume-weighted moving average. Let's actually see price action expressed in a relationship of volume. And we see a rather unique way of looking at the market. Now the look-back period, 200, 50, 20, standard moving average links apply here. I'm going to change this to a nice, simple 100 period moving average. So my median moving average is volume weighted. My look back is a 100 period. And we get a clear representation of price action correlated with volume. So this is the first component of pretty much every major channel-based indicator, always starting with the median. So let's go next to the upper and lower ranges, or the high and the low, between Bollinger Bands, Keltner, Donchian, so forth. High and low are what the next levels within the Jackrabbit Channels Indicator. The high is the upper boundary up here. The low is the lower boundary down here. Price between the high and the low is often considered not very volatile. That is, from the standpoint of a channels-based trading technique. Price action in between the upper and lower boundaries is usually not considered profitable. But we have so many ways now of looking at this boundary. So let's get down into the nitty-gritty and really look at the interesting parts. So right now I have a high moving average of EMA. What if I set it to none? Well, we begin to see something like an algorithmic support and resistance, where the highest highs and lowest lows are tracked. And if I do the same thing with the low, then we clearly get a classic support and resistance. Nice, simple, beautiful way to create a wonderful and vivid potential. In fact, we can even see by looking on the chart, this little area right here could be a very nice buy and sell just on the highest, lowest combination you would get from a support and resistance style trading technique. But we have much more to give than just simplicity at this level. We have a whole tool chest full of unique techniques. So let's go and change the high to a volume weighted high. Let's see how that affects the channel's distribution. And let's do the same thing to the low and build a volume weighted system altogether. And we can see with a volume weighted combination between the median and the upper and lower boundaries, high and low, we have a channel. But now let's adjust our length to equal that of the median. We don't have to, but we can. And let's see what that looks like. So with the length of the high and the low now equaling the median, we get a very nice profit range. We can see that we make a purchase on the chart in the circled region, and then if we follow the market up, we will make a very nice little profit over here if you have a long position. However, if you have a short position and we keep traveling to the right of the chart, we can see we have even more opportunities. So just within the first two layers of a channeled base indicator, we already have clear signs of profitability. But we have so much more we can add to this process, so much more to build on. So let's go and look at the next layer of this entire approach, which is the ATR layer. Average true range is a wonderful way to find out what the market is worth. That is the true range of the price action. By converting the true range into a channel, we get even more information about expected price fluctuations. That is, we are tracking the range of the instrument in terms of where it should go on the basis of predicted history. So by looking for indications outside the true range, we have opportunities to buy and sell. And when those opportunities overlap, the high and the low, as we see on the screen, it shows that we can still purchase. So by looking at all of these combinations, by seeing how they play together, we can build an overall methodology that produces an incredible amount of trading capabilities. So looking at these settings, we can see on the screen how average true range can be put together and used. Right now we are using the RMA moving average, which is constant with the average true range, but we can change that to other forms of moving averages, including if we want a volume weighted average true range. Now I'm using volume weighted because it's a clear indicator most people are familiar with, but you can use any of the moving averages in the list to create incredible, unique approaches. And in fact, it is often best to combine different moving average structures, meaning you don't use the same moving average across multiple layers, because then you get a better correlation of data with different points of reference. So even though we see volume weighted on the screen, this could be simple, Hull, zero lag, whatever you feel is appropriate to get the best out of the market. Now right now the average true range look back is at a 13, which is a typical look back. Let's actually change that and see what combinations we can get. Let's take a true range look back of 89. It's a prime number, it's also a Fibonacci number, and it's a common technique for finding unusual circumstances. And in a few seconds, the chart is going to update and we have our look back. Now, the interesting part is with the average true range is we have a multiplier for the upper and lower boundaries. That multiplier is a factor. An average true range of 1 is just the true range times 1 above the median. In other words, if you put it at 0, then your true range is just going to be your median, and then the factors above it. The mathematics that goes in between the two differences. But if you put it at 2, you're now twice the average range. Three times the average range. And you can see you can hone in the average range to get certain conditions. So it's an interesting little facet on how you can play with the average true range and get those combinations. But it's just the second piece of the puzzle. Let's move to the part that makes the decisions, where we put everything together into a single, complete trading approach. Hit the right buttons here, and that is the actual channels that make the decisions. The upper and lower channels are the ones that actually make the final decisions of when to buy and sell. They are the ones that carry the combination of the average true range and the high-low mathematics. By putting every piece together, we can see how everything fits in the final product. And even here, we can choose how we want to set these up. For example, let's set the upper boundary to none. And we will see literally the combination of the average true range and the highest high combinations. Let's go back and turn them on and see just how that plays together. So let's turn on the upper true range and the highest high. And you can see the combination of the red and teal lines and how they put together to create the black line. Let's do the same thing with the lower values to get the full effect of the indicator as we begin to see how the market takes shape. Now the signals are generated only on the black line, not the true range or the highest high. Just the black line, but all of the information from the other two pieces are put together, including a deviation factor like what you would see in a Bollinger Bands. So let's get back down to the upper and lower boundaries. Okay, let's change our upper boundary to a volume weighted. And let's change our upper highest high to no moving average. That is more of what we would see in support and resistance. Now we can see how the ATR automatically mirrored the highest high. And we can see how the channel itself mirrored both the combinations of the highest high and the ATR. So let's go back down to our channel and let's look at the upper boundary percentage. And let's actually begin to play with it. So by taking this percentage of 0, meaning no deviation above the mathematics, we can see how the signals have changed drastically, just like they would with a Bollinger Band. So let's go to a 1% deviation. Let's go to a 2% deviation. Again, you can see how things play out with the volatility of the market as we increase the boundary of how we look at volatility in relation to the volume weighted moving average. Let's set the lower boundary to volume weighted as well. And now let's set the lower boundary percentage to 2. And we can see that the existing signals that we had completely disappeared. So let's take a look at this chart and see how the overall impact of the combination that we built worked on filtering out the market. Here we can see, even with the extreme case, we have one buy signal that shows a highly volatile situation. So we have literally trapped the market into a very specific volatile purchase point. Let's go back historically and see what other combinations we can find. We have another volatile purchase point where the volatility broke the outer channel. Let's keep going. Through tuning this process and through looking at the market in terms of a combined volatility process, we can get clear representations of profit, and that profit has clear advantages in terms of how we actually tune and look at our strategies. Let's go back into the settings and make a few more changes and see how the market structure changes based upon the indicator. So we have the trade on screen. Let's see. Let's turn the high into a volume weighted, like the lower one. And we see that the selling point changed a little bit. Let's go a little bit different though. Let's see what happens if I go with a sine weighted moving average. So the ATR now mirrors the high, but the high is based upon a sine weighted moving average of the median. Let's change the lower volume, lower moving average into a sine weighted as well, and see how the impact is in relation to what we are doing. And we can see we get even better results. Now let's tune the ATR a little bit. Let's take the average true range. Right now we have an 89. We have an upper and lower boundary radius, the red line, at 100 each. Let's take and set the average true range look back to double that. How does that affect the overall implications of the indicator? And we can see not as much as you would expect. The overlay of moving averages creates a unique situation where they don't always change as drastically as you might think they would, but they can still have impacts above what you think they would. Let's look at the upper median. Particularly, let's focus on this section right here where the black line is actually below the median and the high and the ATR. Let's change the upper median to a 2, or the upper multiplier, excuse me. And we can see that everything changed appropriately. Let's keep going and see just how far we can push these signals. Okay, we are seeing more and more as we change the multiplier of the ATR, how it itself is changing in relation to the combination of the final purchase channel. Now we have actually completely moved the sell signal from a lower price point to a higher price point. So let's play with the lower multiplier and see what combinations we can get out of it. Can we alter the buy signals? Well, we've reduced them. They've changed a little more. And let's see what they look like. So we have an upper multiplier and a lower multiplier that has changed. We see how volatility plays into the consequence of the channel itself. And we really have a very nicely tuned volatility scalping system. Now let's go and look at our upper and lower range again. Right now we have an upper length look back of 197 and a lower length look back of 197. Let's change our look backs to 100 and see how much that changes in relation to the upper. We can see a direct correlation now between the ATR, the high, and then the final combination. So now let's do the same thing to the lower boundary and actually see what the combination here looks like. So by looking through the combinations as we see them, we can see a very interesting pattern develop. And now we only have one buy signal that indicates a very clear, precise point of volatility. As we go through each of these settings and we actually take a look at what these combinations will represent, we have some interesting patterns. Let's look at the median again, and let's push the median look back to roughly 4 hours. And now we have a whole new market structure where the sell isn't triggered anymore. Let's see what this looks like on the chart as a whole. We have a very volatile buy point. Will we find an equally volatile selling point? So far, no. So that's always the interesting part when you change these indicators. You may end up with a situation that might take a longer time than you might want for a selling point or a purchase point. But we definitely have multiple purchase points of high volatility. Let's see if we can keep going. We almost have a sell point right there. And we are close here, but not enough volatility. Let's keep going, and maybe we'll get lucky. Perhaps we won't. But either way, this is one of the important parts of checking your strategies and the combinations of variables that directly impact how your strategy will trade. Finally, we have an incredibly volatile selling point. Now, this may or may not be appropriate to the kind of trading you are doing. So you need to actively check and cross-reference your trades on the charts carefully, because you can be too restrictive in your trading to the point that you might not get enough trades. Let's go back into the settings and adjust it again. Go back to our median, and let's take our median down to 50. Let's see how that affects the volatility of the entire strategy. Okay, now let's change our lower look back at 250 as well. And now let's look at the chart and see what combinations we have available. Well, right away, we can see we have a purchase here and a sell here. So we have more signals. Are they good enough to be profitable? Only paper trading or demo testing can tell you that. but through looking at the volatility of the market, you can get an idea of just whether or not you want to openly and actively trade a condition. Let's go find the areas we were looking at previously. As you can see, tuning the indicator can be a little complicated, but through trial and error and through proper testing, you can get some very nice, profitable trades. As I said in the beginning of this video, channel-based trading is one of the most profitable because it is one of the most common. How you examine your channels or what tools you use really does depend upon your style of trading. Let me know what you think about this video and channel trading in general. What's your favorite style of channel trading? Do you like Bollingers? Do you like ATR only? Let me know. Leave a comment. Share your thoughts about how you do with your channel-based trading structures. If you like this video, please hit that thumbs up. Thank you for watching, and until next time.